Hello, everybody, and welcome to the Everyday Investor. Today, if you're the type of person curious about how things work behind the scenes when you invest through managed funds, KiwiSaver, or when you use an online broker like Sharesies or Hatch, well, this one is for you. But first, let's talk about icebergs. I've never personally met one, but like you, I've been confronted with a few metaphorical tips in my life. And what I can say from my perspective is that often it feels that we're too satisfied with tips of the iceberg. What about what lies beneath? Obviously, I'm talking about investing, right? Well, I think it's because we're too practiced at the art of mimicry. We've memorized the right answer, we've learned the socially acceptable viewpoint, and we're happy to go along with the crowd. We're content with the fact that things work with no regard about how or why things work the way they do. This could be dangerous in a world of transformation. It's a missed opportunity at the very least, and that's my theory anyway. And so today we're going to pause and we're going to consider some of the plumbing in our current financial system when we invest. Even if you have a very basic level of understanding around financial markets and the players within them, you'll quickly observe right now that things are changing. Laws and regulations, standards to adopt, common practices, all changing. These are all just the tips of various icebergs. There's a bunch more to understand just beneath the surface, and it speaks to a larger transformational shift. Last week's episode, if you didn't catch it, covers the wiring of the new financial system yet to come. Today, though, it's about the pipes of the current system. In the future, various forms of value will stream at the speed of light. Today, though, we have fluids. We have valves, we have holding tanks, we have elbows, we have checks and balances, policies and procedures, supervisors, regulators, custodians, and trustees. Can you trust the system not to lose your money when you invest? Can the government or a dodgy KiwiSaver provider steal your money? Well, let's find out why we don't need to worry about those things today. David Callanan is my guest today, and he's a general manager of corporate trustee services at Public Trust. He has a massive amount of experience in the investment industry, both here and in Australia. He has a deep understanding of risk compliance and governance, and I'm really fortunate to have a chat with him today. And I'm not just being nice by saying that, because the type of professional development that I get through this podcast is off the charts, especially because I get to talk to people who can communicate clearly just like David can today. So you're going to enjoy this one. I hope you enjoy it anyway, and it's about something that goes beneath the surface, which I think is kind of important that we consider at the moment. So buckle up, let's get started. You're listening into the Everyday Investor Podcast, passive investing, property investment, managed funds, and crypto. If you're an everyday person wanting to build new wealth for the new world that you're heading into, then this podcast is for you. I'm Darcy Ungaro, your host. I'm a qualified financial advisor, but I'm still learning how to invest better and teach others how to do the same. I talk with guests and cover a range of topics designed to get you to think for yourself here. But please keep in mind, this can't be considered financial advice. Be sure to do your own research here and seek qualified advice of your own before making investment decisions. If you want more information, check out the show notes in your podcast player and make sure that you've subscribed to YouTube also. Then follow the Everyday Investor on all social media channels. The NZ Everyday Investor Podcast receives support from the following partners: Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand; Gorilla Technology, increasing business success through innovative and strategic IT solutions; Ungaro & Co. Financial Advice for everyday people building everyday wealth. Hope you enjoy the show. Let's get started. David Callanan, how are you?
Yeah, great. Thanks for having me, Darcy.
Excellent. So tell me about what your role is with Public Trust.
Yeah, great. Where I might start actually is with a little bit of a history lesson, if you don't mind, Darcy, because I think it's actually really helpful context if we talk about the funds management sector in New Zealand, but also the role of Public Trust and the supervisor and custodian. I think it all kind of brings it together a little bit. So if you can cast your mind back to the 19th century, maybe 1870 sometime, there was a guy called Julius Bogle, who was the treasurer of New Zealand at the time, and he was having a conversation with one of his parliamentary colleagues, and they were really worried about what was happening to some vulnerable Kiwi who were having their funds embezzled by trustees, private trustees. And so Vogel was having this conversation, and he ended up being the Prime Minister of New Zealand a couple of years later. But he became this real advocate for creating a public trustee model. So having a trustee that you could rely on to do these roles and ensure that these vulnerable, so we're talking widows and young children, weren't having their funds or assets embezzled. So he went about this idea of setting up a public trustee. So the interesting thing about that is the same conversations were happening all across the world at the same time. So although New Zealand was the first globally the first public trustee, the same idea, the same conversation was happening around the world. And so there are public trustees in Australia, in Canada, in the UK. So it's sort of the Commonwealth nation, a Commonwealth idea has certainly blossomed and taken off. So you go back 150 years, that's kind of where public trust came into play, and an act of parliament was passed, and the first public trustee was appointed. Now, if you roll forward 100 years, this idea of the trustee, the importance of a trustee, had become a more important role. So I think nowadays, if you think about a trust, often you'll think about like a family trust, and you've got a trustee who's looking after a few beneficiaries. But that legal entity of a trust and having beneficiaries is actually a really helpful structure. And if you were to distinguish it from other legal structures like a corporation or association, the big difference, corporation has got to look after the interests of shareholders. A trustee has to look after the interests of beneficiaries, and that's called a fiduciary obligation. So this kind of legal structure sits behind everything that public trust does. So when it came to the blossoming funds management market, and you've got these groups of people coming together wanting to make investment decisions together and get the most from their money, the trust structure makes a lot of sense. And so 58 years ago, corporate trustee services was set up as a division of public trust, and we started providing these services for corporations who were establishing these trust structures. And trusts are the foundation of fund management, really. Across the country and across the world, this kind of idea of having someone at the top that makes sure that all the investors underneath it are being looked after. So public trust, corporate trustee services has been around for that kind of 55, 60-year time horizon. I'm lucky enough to lead the team here. We're a supervisor and custodian. We look after 13, soon to be 14 of the KiwiSaver schemes, and there's only circa 30 in the country. So this role is a really important one for the well-being of investors, and in particular for KiwiSaver members.
Can you break down the difference though between supervisor and custodian?
The Financial Markets Conduct Act, which is the FMCA, is kind of that's the key. That's the Magna Carta for the way the regime operates now. And in fact, when you're appointed the supervisor, which is, you can just replace that trustee with a trustee. When you're appointed the supervisor, you are also by default the custodian. So we can talk about the difference of those roles, but in fact, they're one and the same. They go quite hand in hand. In practice, the work of the custodian is sometimes shared, or there is, we appoint sub-custodians where there's global assets involved, or there might be other providers that we utilize that have got particular expertise to hold certain types of assets, that kind of thing. But the way the FMCA regime is set up, the supervisor and the custodian are by default the one and the same. Supervisor and you can think of that as a trustee. So the fiduciary obligation to the underlying beneficiaries of that trust, which you could, that is an investor if it's a managed fund, a managed investment scheme. That is the member if it's a KiwiSaver scheme. We have that fiduciary responsibility to look after those investors' best interests. So we're the ones in the room with the fund manager, making sure that they are always thinking about the best interests of those underlying investors or members. So what do we do? What's the work we do? First of all, understanding what the fund manager is doing, or the KiwiSaver provider is actually doing. What's their strategy? What's the product? And we design everything we do around that understanding. In particular, what are the risks that are specific to that fund manager? So I mentioned that we've got 30 to 40 KiwiSaver providers in the New Zealand market. Each of them has got a different strategy. They've all got different products. They've all got different structures, governance, ownership. Right? There's all different sort of nuances within the regime, which is a good thing, but it means that there are different risks for each of those entities. So as a supervisor, our role is basically to go in, understand what they do, why they do it, and then tailor the work that we do as a result. A big part of what we do is actually related to compliance. So making sure they're doing all the things they need to under the FMCA regime, but also just basic stuff like disclosure, making sure that, they can back up the claims that they're making in their advertising, that kind of stuff. Big area is actually where something goes wrong. So we're in there making sure that the error is corrected. Let's say there's a unit pricing error or an asset valuation error, really common occurrences. We'll be in there with the manager, making sure that they've corrected it, making sure that they've communicated with the members. So all of that remediation work, and then making sure it doesn't happen again. So, putting in place preventative controls, because where there's those breaches and there's been some investor harm, the manager's got to correct that and make sure they do right. So that's another important role.
Kind of like a built-in compliance oversight piece that's in there, but it's legislatively there. Whereas separate to that, they have their internal compliance people on anti-money laundering legislation for other stuff as well, right?
Yeah, that's right. I mean, the unique thing about this New Zealand regime is we've got a regulator in the Financial Markets Authority, the FMA, who play this sector market level kind of oversight role. And we as a supervisor are licensed by the FMA as well. So they oversee the work that we do. But given the nature of that role, it's a very broad remit. We have got an entity level focus. So we are really in with those managers or the KiwiSaver providers, and even where we're the trustee on wholesale schemes. And there are a number of other types of legal structures that we get involved in through corporate trustee services. But, the really interesting bigger ones is the managed funds and KiwiSaver.
Yeah.
Right. You've got that. They will have a compliance function who we'll work really closely with. And ultimately, there's a responsibility with the board, and we'll work with the board and upper management in these organizations to make sure that the culture and the frameworks are all working effectively. But there are these layers. And I think that's the interesting thing that works really well actually for New Zealand, is you can have confidence that there's multiple layers of protection if you're an investor into a New Zealand fund or a New Zealand KiwiSaver scheme.
And that's ultimately where I want to get to, because I think when a lot of people are investing, and ironically, it's usually the people that are quite details focused, and usually when they're just starting out and they have a tendency to be very details focused, or have a tendency to be too analytical sometimes, right? Might get stuck on the details, trying to understand the mechanics of how things work behind the scenes. And therefore, if something is unknown, it feels untrustworthy by default. And it's a protection mechanism, I guess. And it makes sense, right? But the reason why I guess it's important to understand a little bit of the detail without being too fixated on it here is that it helps to give investors assurance, knowing that it doesn't necessarily matter too much if the fund manager, for example, makes a dumb decision. Now, I don't mean that from the point of view of making a dumb investment on your behalf. I just mean operationally, if they make a really bad decision, or if somebody working for that fund manager exercises an error in judgment, there is so much control and there is so much structural stuff put in place that it makes it very difficult for investors to actually suffer harm. Is that what I've just said there? Is that true, first and foremost, before I let that get out there?
Well, I mean, with all the disclaimers that I think you're couching that with yourself, which is that ultimately investment decisions come with a degree of risk, right? Depending on the nature, there's different degrees of risk. So certainly, but I think that's right. Overall, if you peel back the onion here and understand how the regime works, you can have a high degree of confidence in the New Zealand regime. And I didn't even start talking about the custodian, which was the other part of your question. And that is another layer of protection that you have. So, the custody business that Public Trust manages, we keep separate from our supervision business. It reports through to me, but the protection of a custodian whose sole responsibility is to keep those assets safe. That's the only thing they have to do, is safekeeping. And that is another layer of protection, that if something was to happen with the fund manager, in that scenario that I was talking about 150 years ago, this concern around embezzlement, if you have a fund manager that's struggling to make ends meet, the custodian will just hold back. They won't make payments to that fund manager until there is confidence that the NTA is in a position, net tangible assets are in a position that these, the assets are appropriately being distributed to the fund manager for their costs. So That's kind of a small example, but it's another layer that this regime has created, which can contribute to having trust and confidence.
Okay. It's like separation of church and state. You don't let your right hand know what your left hand is doing, so that even if there were malicious attempts or bad actors at play, structurally, it's not possible for them to reach over and grab your money, which is being invested in markets, to pay for their mistakes on the operational side of their business, right? And that's important, because if we're investing, we are literally like planting a seed into something that we have no familiarity with sometimes. And a lot of people do invest without really knowing what's going on. They just do it because everybody does it. And if I put more into this mysterious black box, I know in the future, I'm going to get more out. That's really all I need to know. That's cool. But why does it work? Well, I think we should all learn that. But why is it safe? That's kind of the purpose of this chat, right?
So what I would add to the conversation that we're having here, Darcy, is when you have awareness of what that regulatory regime looks like, and we would call that also the retail market, you have to be mindful that there exists a second market that operates, which we'd call the wholesale market, and that's kind of a nice way to say unregulated. Yeah. So in many instances, they will also use this trust structure, and there is a fiduciary responsibility there, but they don't have all of the protections of the FMCA regime that I was speaking to. They don't have the oversight of the Financial Markets Authority. They don't have the protections of all of those obligations of a supervisor, as opposed to just a traditional old school trustee.
Sure.
So if you're an investor, this is an important distinction, and you're going to chuck a bunch of cash somewhere, you want to get that return that you're talking about, Darcy, make sure that's probably your first bit of research. Is this a retail offering? Is it a regulated product? Or is it unregulated? And do I not have all of those protections like the supervisor fulfilling that role? So that's kind of, I think it's worth putting that out there. And if you're speaking to an advisor or you're online doing your research, I think that's one of the first questions you need to ask is, what are you actually pointing me towards? Because I'm not saying that we've got a lot of great clients who work in the wholesale unregulated market, but it is a different structure, and it's done that way for reasons, because it gives the managers more options on what they might be able to do. There's less disclosure obligations, so you get a little bit more freedom to make investment decisions and carry your business out in whatever way you see fit. And a lot of particularly high net worth individuals really like that, because they can really direct and determine what they want to get from the manager, but you get the downside of other risks.
Yeah.
In particular, less disclosure, less protection from a regulator.
Yeah.
There will always be a custodian that's holding your assets and ensuring that they're kept safely, and importantly, independently from the fund manager, that's the key distinction. This independence creates a layer of protection and safety, and backed by a whole bunch of controls and process as well, which is what you touched on before.
Okay, cool. I'm going to ask you a really easy question. What happens if the KiwiSaver provider that I'm dealing with, what happens if they fail or they shut down? Is it even possible for them to fail?
If it looks like there is a provider that's going down that path, there are options to prevent it from reaching that ultimate conclusion.
Yeah.
One of those options, and this has happened a few times in New Zealand in recent and medium term, you will end up with a bigger provider come in and say, look, we'll buy your book, we'll look after these customers for you, and it becomes actually a good outcome for everybody. And realistically, it is the smaller providers who are probably more vulnerable, because they haven't built up the asset base, they haven't built up capital base, that if times were to get tough for them, they're able to lean on that, or lean on investors necessarily to do that. But it could happen, right? So your question is still a valid one. It is a scenario that could arise.
Yeah.
So if that were to ever happen, then under the FMCA, the regulator and the supervisor would work together, and we'd put someone into the shoes of the manager.
Okay.
So for the short term, that may even be the supervisor ourselves walking in the doors and sitting in that seat, working with the regulator to make sure that things are managed and that ultimately there's a transition, particularly for KiwiSaver, because often KiwiSaver members are somewhat less active, so they may be sitting there and just waiting for someone to make that decision for them. It's imperative on us. Again, you go back to that role of the trustee, the fiduciary obligation to the investor. So we'll be there making sure that there is a smooth transition and that those assets are safe, and the custodian will always be there doing that as well.
Do you feel, and this is more just your opinion rather than kind of just explaining stuff, but do you feel that the way that the structure is set up kind of gives an unfair advantage to larger KiwiSaver providers, for example? And I guess the implication there is that when you're bigger, you have better scale, you can access better products, and there's more operational surplus so that you can cover downtimes or lean times. But do you feel like maybe due to the regulation, the FMCA perhaps, is there a risk there?
A great question, Darcy. What I would start with saying is there's a barrier to entry here. You need to have a license. So you need to have a degree of capability to even get your foot in the door to become a KiwiSaver provider. So there's an expectation that you've got financial backing, capability, operational processes, systems, all of that stuff to even get your foot in that door. So but there should be that's not a negative. That's to say, if there's a regulated KiwiSaver provider, a licensed KiwiSaver provider, they've met that hurdle first of all. And I think that's a good thing. You don't just want anyone walking off the street and setting up a fund and doing whatever they want. The question around, large versus small, does that make it uncompetitive? I don't think so. I think, the number 8 wire idea in New Zealand it really is quite true. So we've got some small providers who are growing really fast because they've got the agility of being able to pivot and design their products really quickly. And in a world where you can stand up a website, you can make your technology change really quickly, then I think there's definitely competition. I can tell you right now, there is competition and there is differentiated products in the market that providers are able to leverage. So when I talk about differentiation, that can be across lots of different areas. So you've got active versus passive, and I'm sure you've explored that at length with your listeners before. So we've got both. We've got good providers at both ends of that spectrum and everywhere in between. We've got, banks, all of the big 4 banks have all got a KiwiSaver and a managed fund offering. And yes, they have the benefit of scale, but they have the challenge of scale because they've got data to manage. They've got CRM, customer relationship management. They've got administration burden. And so, it's like the mo money, mo problems kind of piece. So there's challenges that come with being big. Yes, there's the benefit of scale, but there is also a challenge of having to navigate and manage a really big business and all of the expectations that come with those responsibilities. Mm. So there's pros and cons at either end. And I think we've got a very competitive market. I mean, we've got clients at both ends of that spectrum, and you could say that the smaller ones, maybe they have to take some more risk to try and get some market share. But the way they do that is within a field of play that's highly regulated, and they've got a supervisor who's making sure that they're not doing something that's fundamentally wrong. And every decision will ultimately be judged by their performance. So there is this continuous disclosure expectation, or requirement. And if you're not delivering a product that delivers a good service, if it's not getting a good performance, if there's if the investors or KiwiSaver members are not getting return, you're just going to get found out because the regime is so transparent that people will know. Mm-hmm. There's no secret. Okay. So that's a great nurturing ground for a highly competitive market.
Okay, cool. Now I want to move forward, just talk a little bit about some of the changes that are happening behind the green curtain in terms of I was going to say wires, but probably not wires. It's more like plumbing, right? When people are investing money into managed funds or KiwiSaver, they're putting money into a workflow where it moves and then it moves into another place, waits for a period of time, checks and balances, moves to another one. And it's kind of like when you buy a house, you sign the sale and purchase agreement, and then 30 to 90 days later, you change money and you move in. What does it look like in terms of the flow of money that an investor makes, and how long does it typically take before that money actually gets into an investment?
So far in this discussion, we've talked about the supervisor and the custodian. There's also an administrator even the role of the administrator can be split up into different areas. You've got registry, unit pricing. So all of these players, you've got clearinghouses, etc. And so you're totally right. at its very simplest, if an employer, in the case of KiwiSaver, and then of course investors and members make a contribution into a fund, it comes in as cash first and foremost. So the fund has got a pool of cash that's sitting there at all times, available for liquidity purposes to make payments out. But ultimately, what a fund manager is trying to do is to kind of minimize that as much as they can so that they can get an active return from the majority of the assets that are sitting in that fund. Then they're looking to invest that. So they will have teams, depends if you're active or passive, and there'll be a lot of branches to this it depends conversation because it does depend on the nature of the investment. So if you are an active fund, you will have a team of researchers, analysts who will be making decisions on your portfolio of assets within that fund. So that might be, we want to go and buy another 10,000 Meta shares because we think Facebook's going through the roof and it's going to be great. Or it could be we want to buy some gold because we've got high degree of confidence. Or we're going to buy some bonds or whatever that is. So they've undertaken their research. They've decided they want to allocate some of that cash to an asset type. That decision is called a trade initiation. So there's an initiation, trade, execution step. That's the starting point for an investment. You've got two parties basically, right? You've got a buy and a sell side to any kind of deal. So they have an initiation step as well. So you've got them at opposite ends of this process, just like you've got a buyer and a seller in a house. That's the initiation step. Then they need to come together and confirm that's cash on one side for the asset on the other. So that's called confirmation or affirmation. Then you've got settlement, which is where the assets change over. And again, that's the same as you're selling a house. The settlement date might be 30, might be 90 days. That exchange of value happens at settlement. And then after the fact, when the assets are on the other side, you've got both sides of that trade looking to reconcile and make sure it all adds up before they go back on about the rest of their days. Now, this is happening thousands, millions of times a second around the world on every trade, but they all follow that kind of, the plumbing all goes through those steps for both parties. The challenge that exists, including in the property market, but across any of these sorts of trades, is there's this old adage, which is that nothing good happens between trade and settlement date, or trade and settlement second. So even if this is a 5-second process, nothing good happens in there. Remembering that you've got the asset there, which may be accruing value, or it may be declining in value, and you've got cash sitting in there that's doing nothing for anybody. So if that's 5 seconds, that's probably okay. If it's 90 days, like it is for the property, then you've got exposure to risk in the middle of that, the liquidity risk in particular, but also you're just losing the ability to utilize the cash. Neither party can use it because it's sitting there. So to shorten that time frame, processes like having clearinghouses in place who can make this process, the matching, the confirmation happen as fast as, and settlement happen as fast as possible is really important. And the custodians, generally there's one on both sides, are the ones that are taking the asset together and doing that transfer as fast as possible.
Okay. That's a good way of putting it. So we kind of have the trade, the confirmation, the settlement. And typically, at the moment anyway, we have this phrase called T+2. Do you want to explain to me what T+2 means?
T+2 it's an accepted time frame, with 2 being 2 days, that it would take for an asset to go through that trade initiation through to settlement, agreeing, confirming, and exchanging. So the thing that's happening now that I think you're alluding to is in the US and Canada, they're moving to T+1.
Yeah.
So effectively halving the time that you're allowed to take to do this process. So that's a real challenge in New Zealand because we've got this global clock that's really led out of the New York Stock Exchange in particular, for US and Canada. And you've got a compressed time frame for us in New Zealand, who are extensively exposed and engaged in the US stock market to navigate.
This change from T+2 to T+1 is happening, but you're saying that you mentioned before, nothing good happens in between trade and settlement. Some bad things can happen, and that's a risk. Like you mentioned, liquidity risk, but there's also systemic risk, I guess, potentially, right? Like there's all sorts of market risk, pricing risk, all that sort of stuff can everything can change during that period of time. So obviously the shorter you make that time, the less risk you're taking and the less pressure you're putting on that plumbing system, because there's no storage tanks in between the inflow and the outflow of that pipe, where there's less, right? It's moving faster. And you have, I guess, that secondary benefit as well. And that more money is moving around, which means that more good can happen because it's more places at one time.
You're able to more efficiently deploy capital is how I would put it, because instead of having, you're right, sitting in the tanks at either say, or sitting in the plumbing or in the pipes, to use the analogy, that's all, while it's moving, it's not efficiently acting at the other end.
Yeah.
And so maybe we do need to get it to the point where it is more like wiring and it's electrical, because it's moving at the speed of light as opposed to a very slow kind of tunnel. I mean, the biggest risk is counterparty risk, which is where you've decided that you want to buy something and the counterparty doesn't come to the party. The pun not intended, sorry. But you got these, someone falls over, and it's really easy to understand in a housing context, because someone just doesn't bring the cash. And I mean, the protection you have in that situation is that you've got a deposit. But we don't work in that model where you put down a deposit for an investment. It's a full value transaction generally.
Yeah.
So there's the efficient deployment of capital, the liquidity risks, counterparty risk ultimately, but also you've got lots of parties who are probably wasting time. To be honest, in a T+3, the industry made a lot of work to streamline processes to get to T+2. We're now in the middle of doing a lot of work to get to T+1. And US and Canada won't be alone. We know that other markets are going to move there. Australia's going to move there. New Zealand will move wherever Australia moves. So T+1 is just going to be the new norm. So it's doubly important for us, because to achieve T+1, we only have 5 hours from the closure of the stock exchange in New York to confirm the trade. So if you think about the time, I don't know what the time difference is exactly. I know that my NBA games and Formula One races happen the day after in New Zealand, but it means that on a Saturday morning, we've got a time frame to confirm all of the trades that our clients have completed on the New York Stock Exchange or in the US market within 5 hours after the close of that market. So we've now got this obligation. We can't wait till Monday. We need the systems and the people to minimize that gap, make sure that the trades go through. Now, we want to minimize the impact on our people working on the weekends. So the best solution is technology. So straight through processing, validation, electronic verification, all of those steps are things that we invest in for our business to try and streamline the process and get closer to that kind of electronic same time. Because from here, after T+1, the target is instantaneous. And so there's still some work to get to that, but that's where we're heading.
Okay. If we're to think about the pressure points or some of the weak joints, and by weakness, I don't mean that they're not trustworthy, but they might not necessarily be as automated or as capable of transitioning to more digital solutions to speed things up. What would be the areas of slowness in the system right now that will come under pressure to change as T+1 becomes more real?
Generally, it's where the data isn't perfect. So particularly if it's, let's say it's a new equity that a manager hasn't invested in before, a new share, or it's maybe a corporate action that's unusual and the data's not perfect, that's when you're going to get those kinks and the sticking points. So where it's, where you're just buying and selling meta shares, it's just going to, honestly, there is no issue. It's very simple and straightforward. No matter it doesn't matter the value or the scale, the numbers don't matter because it's a tried and tested process. But where you've got, block splits or you've got other changes in terms of corporate actions, then there is a heightened risk that maybe your trade won't settle within that time frame. And that's when you get manual intervention.
And so the ultimate would be T+0 or just T. T and S merge and become what?
T. Yeah.
And you alluded to that before, where wouldn't it be nice if there was wires? And that was like, for me, that was the previous week's podcast was talking about that, was talking about using a blockchain or even distributed ledger technologies so that it can be instantaneous. And that might be a few years away from mainstream adoption. And that's obviously, like technology is disruptive to any space that will make a lot of the kinks in the pipes obsolete and the pipes themselves obsolete. It'll just be electronic information, which is instantaneous. But as we kind of move towards that, which is the attempt, there's probably a finiteness, right? Like there is only so much efficiency that can be extracted out of the current financial system. Would you agree with that?
I think there's still room for improvement from T+1. And I don't think anyone's resting on laurels to say the work will be done, because it's May 28th, so it's coming up very, very quickly. Some of these changes are actively being progressed right now. We're testing some of our processes right now to make sure that they're robust and effective for that sort of go live date. To make sure that's gonna work on the first weekend after the 28th. That's kind of the test point. The next step will be looking to UK, European, and then, as I mentioned, Australia, New Zealand, and it'll grow from that perspective. But then we will look to shorten the time horizon even further. And it's the right thing to do for all of those risk reasons we talked about before. But there is always going to be a small delay where you need the parties to agree they've got all the information they need and connect and click over. That's just the nature of any kind of a trade. I'm totally with you on crypto and digital solutions. Realistically, right now, we're still talking pipes, so it still feels a while away, to be honest with you.
How far away do you think that would be before you see a replacement from pipes to wires?
The question is it a solution looking for a problem or a problem looking for a solution? And I think the opportunity of blockchain is almost inexhaustible in terms of the ideas that you could come up with. The question is, and this we're talking about, it's like cost benefit return. How much do we spend trying to perfect this process for what benefit? And so that's still a question for me. There will definitely be some big providers out there globally who will be thinking, if we can get this working, and blockchain could be a mechanism by which we do that, it's worth the investment. Realistically, for New Zealand, it still feels a way off. And I'm not aware of anyone that's got the scale to invest in coming up with that solution right now in our waters, in our area. But globally, I'm sure that there's lots of people that are looking at it, and we'll be watching very carefully. Yeah.
So with this whole delay between T and S, or T+2 moving to T+1, is there something that we're going to lose in that process, though? Just going back to that, because I understand that it is reducing some risks, but at the same time, it's also creating some, I guess, circuit breakers as well, right? Like if, say, for example, there was a worldwide event led to mainstream people panicking en masse, and they all want to dump their assets and sell, liquidate, send it to cash, withdraw it, put it into gold, whatever. If something like that was to happen under the current system, there's at least some delays where things just don't move through the pipeline, right? Is that right to start with, that it is kind of like a circuit breaker? And are we losing some of that if we shorten the settlement period?
Yes and no. I think things still get better because the more liquidity you're able to utilize, the better you're able to navigate those. Just as a general principle, I think improving access to liquidity is a positive. There is a small disincentive, or maybe I'll put it this way: there is a challenge in jurisdictions like New Zealand as it is, because we run on a different market. Our markets open and close on a different time zone, and if naturally analysts are operating in kind of business hours over here, and you've got markets around the world that are already open and trading all the time. So that's not something that can be avoided. That's just reality. So we have an exposure just because we're in a different part of the world to everywhere else. But if you go back to 100 years ago, Black Thursday, massive stock market crash and Great Depression, and all of the bad stuff that happened back then. I mean, kind of the same. All the principles are still the same, but what you do have is that things could happen more quickly, and I think that's your point. That deterioration, there might be a sense that it could happen more quickly. What the counterpoint I would have to that is that we've got far greater diversification now. If you think about the number of stocks that were available to buy and sell on the New York Stock Exchange 100 years ago, there's nowhere near the degree of diversification that's available now. in terms of asset types, even just in terms of the pure companies that you could invest in. We've equally got a challenge in New Zealand, where New Zealand is still to this day heavily dependent on agricultural resources. So that's an exposure point for us as a country, just as much as those kind of time zones. And we, as a result, we have to invest globally because we just don't have the strength in the stock exchange in the market that we have here.
I have so many more questions, but I know we're quickly running out of time here. I want to know what your views are, professional, of course, around the increasing innovation that we're seeing in the area of self-select. And it might not be 100% self-select where you can choose individual securities. You might have an advisor who will be either warning you or giving you some guidance. But to a certain degree, there's a certain amount of customization that investors can exercise now rather than just select A, B, or C off the shelf. From a risk point of view, from just general best practice point of view, do you see this increasing ability to self-select as risky?
Yeah. Simple answer. With risk comes opportunity too. So that's the reality here. So it comes down to getting good advice, talking to somebody that you trust, and making a decision with your right investment horizon in mind, with your risk profile in mind. I know none of this is new to you, Darcy, and I'm probably just reinforcing stuff you talk about to your clients and to your listeners all the time. But the same applies here. If you individually think you can beat the market, statistically, I'd say you're unlikely to be one of those lucky few that can beat the market. Doesn't mean it's impossible, just means that the chances or odds are not necessarily on your side. So if you're going to put all your eggs in one basket, you're taking risk, you're taking heightened risk. And so you need to get advice. You need to do your research, think about what's the right decision for you. There are providers that will sell different types of products for different risk appetites. That's the benefit of a competitive market. So you've got to decide what's right for you. For me personally, if you're going on, particularly if you're investing for a short time horizon, you need a bit of safety and security. If you're planning to buy a house in the next few years, I'd encourage you to invest in something that's lower risk so that you know what you've got there and you're not going to get big fluctuations in value.
And if you're thinking about buying a home in the next 5 years, hey, you probably shouldn't go on the high growth option. But just on that topic again, for those that are interested in these self-select options where you can say, hey, I'm just going to create my own portfolio completely using these tools here. Do you think it should be mandatory for those types of options where there is some degree of financial advice independent of the fund manager? I know that's not your role to say, but maybe this is a question for more the FMA, but to me, it kind of feels like it's a bit of an accident waiting to happen, where those that are keen just to go all in on black and just hope for the best that looks like it could be a disaster waiting to happen. And often it's usually those people that aren't taking advice. What are your views, if any, on that one?
Well, I think if we're talking about KiwiSaver, it's not a risk that we would want anybody to be taking, really. And so those controls, I think, is something we should look at. When it comes to your own investments, then maybe it's a different scenario because it's kind of excess capital, you've got a bit of extra buffer and you're willing to take a gamble. But yeah, I think when it comes to KiwiSaver, the more people are getting good information and getting tailored advice, then the better outcome they're going to get from their investment. So I would definitely continue to advocate for that. What I would also say is it's not just advice, it's ongoing financial literacy.
Yeah.
There's lots of other, even just your banking products, your insurance, getting a will, having a power of attorney in place, health and life insurance, because there's lots of risk, not just market risk in terms of life. And that's where I would say speaking to an advisor, speaking to someone that you can trust will help you get that balanced view of your overall financial well-being. Your legacy also potentially is something we at Public Trust talk about all the time, is what's your legacy, which is more than just a financial piece. And so, yeah, very much I think lifting financial literacy and giving people access to advice, hugely important. There may be a role for AI to play in that in the future. Robo-advice is, I know that there are providers in the New Zealand market that provide some services in that regard. But also even advisors, they've got a job to do to maintain their competency, They've got to keep up to speed with what's happening in the markets, what products are out there. There's not just one solution here. There's quite a few different things that we need to get right.
Yeah, that's good. Do you feel that the financial advice providers or the financial institutions and even the regulators are doing a good enough job in the area of financial literacy?
I think there's always room to improve. I mean, I wasn't raised in the New Zealand education system, but I do hear quite a bit from New Zealanders, particularly young New Zealanders, like the current generation coming through, who kind of wish they'd had more opportunity to learn about good financial management, good budgeting. So we used to in the last few years find that the majority of applicants for financial hardship were people going through a significant financial event. So they might have lost a job or a marital split, or something really, a big change in their circumstances. We're seeing now much more people come through that just a shift in the interest rate has meant they're falling behind and they're now in hardship. A lot of the time, and there are providers who are providing, so it's KiwiSaver providers that are adding this to their service. If they can get some good financial advice, do some good budgeting, they may actually not need to go to that final step of drawing down on their KiwiSaver because they're in hardship. They might be able to help themselves. What I guess I'm pointing to here, though, is that there's quite a few people out there who just aren't that great at budgeting.
Yeah.
And they need some basic help and basic support. They don't understand some of the, simple mechanisms of cash flow, personal cash flow. And so that tells me that there's a gap. There's definitely a gap for particularly a current generation that are coming through. We need to support them. We need to invest in financial literacy. And that probably starts right at primary schools. I don't think it's a political issue. It should be a bipartisan piece. And if we could get that right, then you're going to, you put that fence at the top of the cliff instead of ambulance at the bottom, which unfortunately is where we end up coming in.
Yeah. Hey, this has been a great chat. I really appreciate your time, David. If people want to follow you personally, where's the best place for people to follow, social media wise?
I mean, I'm on LinkedIn. If you want to connect, I'm happy to have a chat with anyone, anytime. Yeah, and in terms of public trust, I think go to the website, check it out. If you don't have a will, if you don't have an EPA, then an enduring power of attorney, then have a look at the public trust website. It's a really easy process. Or speak to an advisor and get some advice on where to go next from there.
Cool, awesome. All right, really appreciate your time today, David.
Yeah, great. Thanks, Darcy. Enjoyed it.
See ya. Thanks for listening into the Everyday Investor Podcast. Like what you've heard, but you want more? Make sure that you've subscribed to our YouTube channel and subscribe to the Everyday Investor newsletter too. The links for everything are found in the show notes that you can access easily by swiping or tapping over the cover art in your podcast player. If you received value in some way, I'd love it if you could take the time to write a review wherever you listen to podcasts. Share it with a friend, or think of our show partners where appropriate. Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand. Gorilla Technology, increasing business success through innovative and strategic IT solutions. And Ungaro & Co. Financial advice for everyday people building everyday wealth. Remember, some investments or strategies discussed on these episodes may result in financial loss. Be sure to do your own research and ideally seek qualified advice of your own before making investment decisions. Hope you enjoyed today's episode, and we'll catch you next time around.